The Q1 earnings season is wrapping up. Companies easily beat top and bottom line estimates that had gone up ahead of the start of the reporting cycle, unlike in past when estimates would go down before the earnings releases came out. So let's put it all into perspective now with our chief equity strategist and economist, John Blank. He'll give us his read on what's going on. John, one thing that caught my eye for this Q1 season was a published report that said firms that beat EPS estimates in the past typically outperform the S&P 500 by 100 basis points the day after they report. But this earnings season, the typical stock that beat on EPS outperformed by only 51 basis points. Is that indicating a problem?
Well, Terry, we got basically all the S&P 500 companies in aggregate to talk about. 86%. So basically 9 of 10 reported an EPS surprise, and 76%, basically 8 of 10 reported a revenue surprise. So surprise is a word that becomes irrelevant when there's 8 of 9 of 10 companies reporting one, because there's no surprise. Surprise should be one of 20 or 30%. So the surprise concept just went out the door. And then what you're driving at is the outperformance was much less, which suggests that if you outperform by 50 basis points or 100, basically what we're looking at is that the analysts in this concept of so wide a compression of beats were actually more accurate than usual, which is kind of interesting more than anything. The market has been pricing the S&P 500 at 4,200 for some time now, 41 to 4,200, and it's been consolidating. But what this says is actually the analysts had a pretty good read on this earnings season, and that's kind of the hidden story behind those huge beats and surprises.
Interesting. You say the very high earnings growth rate we've seen is not solely due to the easy comparisons to the year earlier period. What else factored in?
Well, Terry, one of the things that clearly happened, I mean, if you just look at the earnings growth numbers as in aggregate from 2011 on to 2021, when we entered this pandemic, we were at 180, and we're going to be at 200 in earnings, now in middle of 2021. So that's just basically a 12% growth rate, 6% a year, plus taking in account some inflation, 2% inflation. So you're looking at, for what's surprising is just basically a return to the trend growth rate of earnings for the S&P 500 with a big V-shaped COVID suppression element behind us. So at this point, the lesson here is we're probably back at trend, and we're probably just going to grow at trend, which will actually seem slower now than what we've seen in the last 2 quarters.
So were the analysts too aggressive in their downward revisions to the EPS estimates during the first half of 2020?
No, they got it right, Terry. It was there was reasons to believe the suppression was the case, and they got it right for those 2 quarters in the first half of 2020 because of the vaccination story, and they're trying to price it in. They did a decent job. I just think now is a different world.
Do the Q1 results provide a good reason for continued forward-looking optimism?
Q1 results don't matter at all because of the COVID suppression of the vaccine, so that it's basically irrelevant.
But it seems that the earnings season provides the market with a decent tailwind going forward, right? And what are some other factors there?
Well, the biggest factor here is we've got, close to 9 or 10 states that are at 70% vaccination rates, which is a fifth of the country, and basically 40 to 50% for everybody else. Add in a 10 or 15% of people who probably got the vaccine, the COVID anyways. We're clearly, given the case out there, we're definitely close to herd immunity or probably in it for half the country. So this is the real tailwind that, basically the United States is better protected from vaccination drive than anywhere else. And that means the rest of the world can catch up. The rest of the world can benefit from our vaccination exports. And we have some type of geopolitical in the face of the Chinese vaccination drives and vaccines being so much worse than ours. So that's where the optimism is that we can get the 40% earnings in the S&P 500 not from the United States to be the next catalyst upward.
Big tech has come under some pressure recently amid a shift out of growth stocks and into the cyclicals, despite the fact that the big five tech companies collectively enjoyed year-over-year growth rates of over 100% in earnings and about 42% in revenues. Do you think that's due to that inflation talk that's out there, or is it a sign that equity markets are overbought?
I think the real issue here is actually the anti-competition. That it's really not about inflation. When you talk about big tech, they don't really have anything to do with that, and it's not really about overbuying because they're. I looked at Apple this morning. The PEG ratio of Apple's about 2. That's pretty much standard. So what's really going on is they're just so big now, and that is bringing competition, litigation in Europe, in China, in the United States, pretty much everywhere that these companies operate. And that's what's slowing them down now.
Been a lot of choppiness in the market this month. And as we speak, we're just about wrapping up the last full trading week of May. Is this market choppiness that we've been seeing going to last into the second half of the year, or should investors sell in May and go away?
I'm not, Mitch Sachs wrote one and debunked the sell and May and go away thesis, which is a good idea. But I do think consolidation will probably carry on for a few months just because of the ability and need for this market to digest things. The reason I think that is the forward PE ratio is 21.2. The 5-year average is 18. So you're looking at a 15% overvaluation in this market. And somewhere in the mix in the next 8 or 10 months, a 5 or 10% correction should come to pass.
And what are you calling fair value for the S&P 500?
Terry, I've been on 4,100 for the last couple months. The market's at 4,200. And for my next strategy report here another week, I think I will leave the 4,100 and play for a few more months on this idea that consolidation and some rotation around that fair value target is more likely than not. And then maybe, I get more bullish about raising that target in the fall. And that's kind of where I think, what's going to happen. Not that we're going to go down, but we certainly could. But really that consolidation for a few months is a desirable thing.
All right. 3 fast-moving stocks on your radar right now are BioNTech, I hope I pronounced that right, Western Digital, and Orient Overseas International.
Yeah, so these are, story stocks. These are headline stocks. Let's talk about them so we can dispense them. BioNTech, obviously, the COVID vaccination. It's actually number 1 ranked stock. So why am I skeptical? Well, in 2020, you could have bought this at $20 a share. It's $230 a share. $25 in earnings expected next year, $30 this year. So actually not a PE ratio is pretty low. Fascinating story. I would buy it on a pullback. It's been on a run from 100 to 220 the last few months, and it's a little rich for me, but interesting stock. Let's go to the next one, Western Digital. This is obviously really benefiting. You're looking at $9 a share on a $90 or $75 stock. Tough not to like this stock, even though it's got down in the 70s. You're looking at with a $9 a share earnings, you're looking at 8 or 9 PE, and there's a semiconductor shortage. You got to like this stock for another move higher. It's been consolidating for a few weeks. Third one is this Orient Overseas International. This is a Chinese shipper. $14 a share next year. It's at 60. This one I would say of the 3 I like least because I think the shipping story is probably going to get increase in its value and then probably be overlooked, much like the testing companies last year were, because people will look beyond the shipping, pleasant straits for shipping for the last few months and look to some pullback, because this is a very competitive, very, very price competitive business, and people might sell this and not buy this. So amongst the 3 names, I guess I would take Western Digital first, BioNTech second, and this Orient Overseas as my third pick.
All right, Stock Talk with our chief equity strategist and economist, John Blank. With John, as always, I'm Terry Ruffalo. Consider this. Why are insiders buying company stock with their own cash? There can only be one reason. They expect a price jump. Zacks is revealing the best of these buys for your consideration until midnight, May 30th. Find out more at zacks.com/promo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.